Welcome to another episode of Money Talks with Lynn Kitchen. I have an important and exciting show for you today with my guest, Lisa Rehburg. What we are going to be doing is talking about a topic you probably have never heard of before in your financial life. And because I didn't know about it either, and it's something called insurance settlements. You can correct me if I'm wrong, Lisa, but Lisa is um, president, CEO of Lisa Rehburg Settlements, right? Settlement insurance. And insurance is potentially an area of unknown to most of us, and that's okay. We have an opportunity today to learn something maybe you've never heard before. That might be a first. And I love firsts, don't you? All right, well, let's get started. I would like to introduce to you right now Lisa Rehburg.
Thank you for having me, Lynn. I really do appreciate it. And I'm excited. I just love to raise visibility for life insurance settlements because, as you mentioned, so many people don't know about them. And I'm just going to start off with this real quickly. 2.5 million seniors a year will lapse or surrender their life insurance policies. They basically get rid of them. And they could be leaving a lot of money on the table. So that's why we're here. And I'm just so honored to be here. So thank you.
You're certainly welcome. Now, we're talking life insurance policies that most people, when they get to the point where they can't afford them anymore, maybe you're in that position, all of you who might be watching today, maybe not, but you might have a parent or a loved one who is in this position, or somebody that you could be advising. If you know somebody who has an insurance policy that they've been paying premiums into, maybe for decades, and suddenly can't afford them, or for somehow it's your life has changed and you don't need the death settlement anymore, the big lump sum at the end of life insurance. There is a way to actually sell that into what we call a secondary market or another market and get lump sum cash. This is something I have never heard of before, mostly in my lifetime, Lisa. Everybody that I've ever known who couldn't afford their life insurance policy simply surrendered it for nothing. And I know that that's kind of a shame. And tell us a little bit about this new aftermarket or secondary market where you can actually sell to somebody else your life insurance policy and receive a lump sum. How does that work?
Right. So it's called a life insurance settlement or life settlement for short. And think about it like selling your car. Your car is an asset, right? Your
Yes.
life insurance policy is an asset. Any life insurance policy
Yes.
is an asset, including terms. So what happens is clients receive a lump sum of cash and they basically sign the pink slip of their life insurance policy, right? AKA the car analogy. So when you sell
Yeah.
a car, you get a lump sum of cash, you sign the pink slip of your car over to the buyer, and they drive off with the car. Very similar. Clients get a lump sum of cash. They sign that change of ownership form, AKA the pink slip, of their life insurance policy over to the buyer. The buyer takes over the policy. They pay the premium and they are making themselves the beneficiary. They're going to receive the death benefit at some point in time in the future. So they're not doing it out of the goodness of their own heart. It's an investment for them, but they're important because without them buying policies, we can't help clients.
Oh my gosh. I have had a client who came to me 18 months ago in this very situation, Lisa. She said to me, "Can you help me, Lynn? I've got this life insurance policy that her husband, who she's now divorced." And this is the problem was that she went through this ugly divorce. But her husband had a life insurance policy in her name that they had been jointly paying the premiums on, and after the divorce she personally has been paying the premiums on, and she came into hard time, and she said, "Can you help me? Can you call the insurance company for me?" Which I did as an advocate, a financial advocate. I called the insurance company. I talked to the agents. the life insurance agents to find out if she had any other choice besides giving up the policy. And you call that surrendering the policy. And they had no clue. I mean, they did not even refer to this possibility of being able to sell it to a third party. Potentially, they're hoping that the client will just surrender. Could you talk about that from the point of view of why that occurs? And let me just say this: had I known you at that time, I could have uh, referred this woman to you, and potentially, I mean, the death benefit was something like 200,000. And maybe you could speak to what she could have received had we known about the possibility that it's saleable.
So two things. First question is about why the life insurance companies don't talk about it.
Yes.
And I'm going to backstory this real quick. I believe in life insurance. I think life insurance is really important. And so I'm not talking about big bad life insurance companies here, but from
Okay.
their perspective, right? If a client lapses, that means they stop making the premium payments and they let the policy go, or they surrender it, as you just mentioned. They go grab the cash and they let the policy go. The life insurance companies say thank you, because clients have made premium payments for a long period of time, and now the policy is gone and the carrier does not have to pay a death benefit. But when a policy is sold, the insurance companies know these buyers are not going to let these policies lapse or surrender, right? They are going to keep them all the way through. And so, from a life insurance company perspective, they're not excited,
Yeah.
because they know they have to pay a claim at some point in time in the future. Now, one could make the argument that they're also collecting premiums for 5, 10, 15 years, whatever that happens to be. But in their minds, it's like, nope, we've got a claim we have to pay and we're not happy about it. So that's that answer to
They're
that question.
basically saving future cost by allowing the client to surrender, um, and they're giving up potential future cash flow coming in, and so they're balancing that.
Mhm.
So it's really just to them a mathematical equation. It's in their best interest if the client surrenders, and
Correct.
and but they're not going to go out of their way to give the information that people like Lisa Rehburg exist.
Correct. And neither will our agents.
Neither
And
will an agent.
neither will their agents,
Their
right?
agent.
So right.
Okay.
So like an independent agent may know about this. I
Okay.
have found that many don't. I have found that many financial advisors don't know about it, or they're not comfortable with it, or they're
No.
not they have misperceptions about what it is or how it works. So there's a lot of uh, people aren't knowledgeable about it because the visibility is just not there. And so that's why I'm so delighted to be here. Now, the other question that you had was
Yes.
about your client that had the $200,000 policy. And we're life settlements brokers. So our job is to market a client's policy to get the most amount of money for it that we can. And the reason that's important is these buyers, not unlike you or I, when we're buying, I'm going to use a car analogy again, right? These buyers are not trying to pay the most amount of money for a client's policy. They're trying to get it as inexpensively as possible. So unless
Yes.
they have competition, they're not going to give a client the best offer. And once again, not unlike you or I, if we go to the car dealership, we're not trying to, pay the most amount of money for that car. We're trying to get a deal.
That's
Same
right.
thing, right? So we're here, like I said, to introduce competition, get the most amount of money. So the answer to that was the preface, but the answer to the question is we do not know until we market a client's policy. But I can tell you this: the buyers are looking at, number one, what are the premiums? What are the premiums going to take to continue the policy?
Yes.
The lower the premium relative to the face value or the death benefit of the policy, the more money they're willing to pay, because they have to put less money into the policy. The second component that they're looking at is how long do they think they have to make these premium payments, i.e., what do they think a client's life expectancy is? In our world, the shorter someone's life expectancy, the more money these buyers are willing to pay because
Oh,
bluntly, they're going to get their investment payoff
yeah, sure,
sooner, right? So they are
sure.
not looking, frankly, bluntly, for clients that have 50 years of life expectancy. This is not for people in their 30s who are running marathons. Typically, these buyers are looking for clients with 10 to 15 years of life expectancy or less, sometimes 20, and every once in a while a little bit beyond that. So the short answer, that's a long answer, but in your client's particular question, circumstance, it depends upon those premiums and her life expectancy. If
Got
very
it.
short life expectancy could be $100,000, very long life expectancy, frankly, could be zero. But
Well,
the
let's
good,
say
yeah,
in the case that she was around 60 years old,
mhm,
had had the divorce,
mhm,
200,000 a
mhm,
death benefit, her life expectancy by means of the calculation or the, expectancy tables,
right.
for women, maybe 85. I don't know, maybe it's higher now, 90. I think it is probably for women now.
Mhm,
But you're right. Then, because from 60 years old to a 90-year-old or 85-year-old life expectancy, that's 25 years,
right.
30 years. And so the buyer would be looking at that
Mhm.
before to have to pay the premium. So what you're saying is that when you sell this life insurance, the buyer is bound by the life expectancy table of the original owner. Is that correct?
Original insured, correct.
The
Yes,
original
because the
insured.
client
Okay.
is still going to be insured, right? They're going to have nothing else to do with the policy, but they're still going to be insured. So you are correct that the buyer is bound by a client's life expectancy.
But
Um,
let's say theoretically she could have, if all things were in pretty good favor, maybe received $15,000 or 20,000 as a settlement, which would have been a nice sale, if she had, relative to what she probably did do, which was surrender
mhm.
and gotten nothing.
That's exactly right. We're just here to get clients more money, right, than lapsing or surrendering. And last year, the statistics for our market were that clients who sold received 6.2 times more by selling their policy than by lapsing or surrendering it. So 6 times on average.
I see.
Mhm.
Now, could I ask you a little question about the buyers? Let's say I'm just trying to get my mind around the marketplace.
Mhm.
And you made a really great analogy of selling a car, which is an asset, and in a life insurance policy, whether it's term or life, is an asset. I
Mhm.
absolutely get that, and everybody here gets that. And so the possibility is that we're selling this asset for something, and we're selling it to somebody who is looking at it that it has some value to them. And as you mentioned, there's maybe hopefully more than one person who would be vying and offering, and maybe just like maybe making a better offer. And hopefully that's why you come in, because you're the broker and you have a potential group of people that you go to, potentially representing the seller, or do you represent the buyers?
That's a
Please.
good question. We are on team seller. So
You're
our
on team seller.
fiduciary, yep, our fiduciary duty is to clients,
Okay,
not to the buyers.
interesting. But you have access to the buyers, and you know where
Absolutely.
to go to get a conversation with the buyers, and maybe more than one buyer.
Yes, and we market a client's policy to as many buying entities as possible. And I'm going to real quickly sidebar real quickly, but we are a very highly regulated market, and we do not sell clients' policies to their next door neighbor, right?
Oh,
So that's really important to know. We only work with and sell policies to entities that are approved by each state's Department of Insurance, and that is really important. So you can't just walk into a state and start buying policies. You have to be approved by that state's Department of Insurance, and it's not just a 2-second process, right? I mean, there's HIPAA protections that have to be demonstrated, bonds that have to be posted. I mean, there's a lot of background checks that have to go on here, and
Interesting.
these buyers can be and are audited, and so all that is very, very important. But you asked the question as to who these buyers are. They
Yes.
tend to be hedge funds, mutual funds, college endowment funds, pension funds, institutional money. Mutual funds are in there, so sometimes banks are in there, sometimes insurance companies are in there.
Oh,
But this is, yeah,
interesting.
this is large institutional money. Now, sometimes it's high net worth individuals. Once again, we are not selling directly to that high net worth individual. They are the money, if you will, behind these licensed, approved entities. But
Okay, so
there's
really,
HIPAA protections in
what
place.
if I could interrupt for a second?
Yeah,
What I'm hearing you say is that the buyers are institutional or quasi-institutional
right.
people who are looking for an investment that they can purchase for a price, and then the end return on their investment really is the death benefit. Now, and then they will be paying in or taking over the policy, taking over the payments. In the meantime, they're looking upon it as an absolute investment, nothing more than that. So that kind of answers one question for me, because I was wondering, uh, what about in the case of when someone has to give up their policy because they're ill,
Mhm.
and they can't. Well, remember the AIDS
Yeah.
epidemic when we had a lot of young men, frankly, who had AIDS and were uninsurable, really. Um, but what I'm hearing you say, it's not like the buyer who might be uninsurable is looking to take over somebody else's policy. That's not it, right?
Well, our market started in the 80s with the AIDS epidemic and viaticals, as you were describing. So this has been legal since 1911, but the market itself started in the 1980s with AIDS, people who were selling their policies to try, experimental treatments. But fast forward, as medical technology allowed us to live longer, the Life Settlements Association, the Life Settlements market was born, and the Life Insurance Settlements Association was highly involved in getting our market regulated, and that's really, really important. But I'm going back to what I think you're talking about is, if somebody is super ill, right, they have a
Yeah.
very short life expectancy, 6 months, a year, whatever that happens to be. um, do we sell those policies? We do. It's not common at all, because frankly, if somebody has 6 months or a year to live, they probably should keep the death benefit for their family, right? That would make sense.
Yeah. Find
Sometimes it
find
makes
any way means necessary to pay those premiums.
Sometimes it makes sense, though. I have had clients that have very significant health issues, and they have those short life expectancies. And sometimes I go, Lisa, bucket list. Like, I know I have a short life expectancy. I want the money to be able to travel or do whatever I want to do, or make my life more comfortable. That is not a common scenario, because frankly, life insurance policies now have accelerated death benefits and critical illness benefits, where clients can access that death benefit sooner,
Ah,
and that's going to be a better solution for them
I see.
in that particular case. But I've talked to clients that have significant health issues and haven't been able to qualify for those benefits. So it's case by case for sure, but most of our clients are not in that situation at all.
Okay, good to know. So, could you, Lisa, give us a couple of scenarios of your common uh, cases where you feel like you've really gotten a win for your clients?
Yeah, I just called one this morning, and actually, he called me. Got a wire transfer. I got a notice this morning about 7 o'clock in the morning that a wire transfer went out for a client, and I didn't want to call him that early, so I was going to wait till, like, 9 o'clock at a decent hour. And he calls me at 8:30, and I didn't even like. I just saw his number, and all I said was, "You got paid, didn't you? You got
Oh,
money, didn't
you
you?"
knew what he was calling. He was calling to celebrate with you.
Yes, yeah, he was. So his situation is he has a, $2 million term policy that was ending, and he wasn't going to do anything with it. It was still convertible to a permanent policy, but he wasn't going to convert it. He didn't need it anymore. It did its job, right? He had it for 20 years, covered everything that he needed to in case something happened to him over the past 20 years. His wife would be taken care of, but they have assets now. And they're retired now. And so the policy, like I said, did its job for 20 years and just didn't need it anymore. And so we marketed the policy, and we got $25,000 for him because he is healthier, right? So he's got that longer life expectancy. And those premiums to carry the policy were pretty expensive. But in his mind, it beat zero because he was going to have zero, right? When that term policy ended, there was going to be nothing there. So 25,000 is enough to have a little fun. The
Yes.
another So we see term policies all the time. They're very common to market. They're very popular to market.
Could
They
you
are, I'm
could
sorry.
I ask you to pause
Sure,
1 second
sure.
and just for the benefit of those of in the audience who they don't know the words, could you just give a quick definition of the difference between term or term insurance and uh, universal or life insurance?
Sure. Yeah, and thank you for that, because you know how we are in our own little industries. We have the lingo, and
Yeah,
we don't take people with us. So there's two types of policies underneath the life insurance umbrella. One type is term, the other type is permanent. So
permanent.
term is like renting, permanent is like owning, right? Term does exactly what it says it's going to do. You have level premiums for a certain amount of time in the term, whether that be a 10-year term, a 15-year term, and the one I just talked about, a 20-year term. Basically, he
Is
had
that
like,
like a car lease? Is like a car lease
yeah,
rather than buying your car, it's leasing a car?
kind of like that. Yeah, kind of like
Okay,
that. Absolutely. So, so once your level term period ends, right? Once those level premiums end, your policy doesn't end, but your premiums just skyrocket. So, right, that's why term premiums are less expensive, because at some point in time they're going to skyrocket. So their other type is permanent insurance, which does what it says it's going to do, and underneath that category are universal life policies and whole life policies, and there's some subcategories, but let's generally universal life and whole life. Universal life, both, let me back up, both of those types of policies generate cash value, so they're going to be more expensive, but what happens is part of that premium goes into cash value into the policy, like a savings account
right.
into the policy. So that's why they're higher than term, because you have that cash component, that savings account component called cash value. Universal life policies are actually our number one seller because they tend to be less expensive than whole, but they can implode. And I don't want to get too wonky with it, but whole life policies are more expensive than universal life, and they tend to carry a lot of cash. So the cash accumulations are higher in whole life.
Now,
Universal, go ahead.
does both term and permanent, do they both have this death benefit that we're talking about?
Correct. Yes, they're
Okay,
both life insurance policies. Yes.
okay, that have like an end, a big amount at the end as a benefit that
Mhm.
you're buying this because if something happens to you, then somebody gets a benefit to, or you get the benefit if the policy is on somebody. I don't know how does that work again?
Okay, so for instance, my husband and I have life insurance policies on each other. And
Okay,
so, right, if I pass away today, he will get the death benefit of the policy,
okay,
right? If because he's my beneficiary, I
right.
am his beneficiary. So if he passes away, I will receive the death benefit of the policy. I'll receive the
Of a
whole amount.
separate policy that he owns.
Correct.
Okay,
Yeah.
good,
Hmm.
good,
Yep.
great.
So bottom line here is, um, the universal life policies are very popular to market because what happens over time, and I'll give you an example. What happens over time with universal life policies is when we get them in the beginning, that cash in those policies was projected to grow at at a certain interest rate. In other words, when these were purchased a lot of times 15, 20 years ago, our interest rate environment was higher. And
Yeah.
so we had 15, 20 years of very low interest rates. And so what happens, the cash and the policies when they were purchased was set to grow at 6, 7, 8%, but instead they grew at 2, 3%. So the cash that was supposed to be up here to carry policies is now down here.
Yeah.
And so we call that imploding, because as we get older, the cost of insurance goes up and it starts chewing up that cash. And so a lot of clients are finding themselves in their 70s and 80s with these policies that have no cash in them or little cash in them, and they need to put more money in them to keep them going, and they don't want to, or they can't. And I'll give you an example. We
Right.
just sold a policy for a 90-year-old gentleman, and he has a $150,000 universal life policy. He
Okay.
is paying $1,600 a quarter now to keep
Wow.
that, right? Exactly, to keep that policy going. And he lost his wife about a year ago. So she was the beneficiary on the policy, clearly not really needed anymore. His kids don't want to pay the premium. There's no cash in it. So the surrender value is zero, right? If he went to the insurance company and said, hey, I want to surrender my policy, he'd get zero.
Yeah.
And he just doesn't want to pay the premiums. Like, there's no need for it. And I can save, 6,500 or whatever it is a year by not having this policy.
Right. So you're saving him that outflow in cash, and you're putting it up on the market. You're helping
Right.
him sell it, put it on the market, just as if it was a car that has some value somewhere to somebody, and you're the person as a broker who knows how to contact the people who are willing to pay for that. So this is kind of a private. Um, how public is this? I mean, how many of you brokers are out there? Are you quite rare, Lisa?
Yes, but if I can real quickly explain what happened with his policy. The
Oh,
opening
sorry.
offer. No, no,
I'm
no, no,
sorry.
no,
I
no.
interrupted.
No, you did not. No, you did not
Okay.
at all. It's a great question. I don't want to lose that question, but I wanted a
Okay.
backstory real quick. The
Great.
opening offer on his policy was $15,000. By the time we were done marketing it, 43,000. So
What?
yes, because we had multiple buyers that were interested in the policy. What gets really fun is when you have
Bidding
two.
against each other?
Yes, and what's funny is they start leapfrogging each other, and that gets really fun. I have a policy right now where we started, and I'm not joking, at $15,000, and we are now getting this client $150,000 on a $450,000
Oh
policy.
my
So,
goodness.
so the answer to your question about me, yeah, there's not that many life settlements brokers in the country.
Well, are you I'm just stunned. I mean, you're a diamond in the rough. You need to be known by everybody. I need to make sure that everybody in my audience knows about you, first of all, and then we need to get you known out there in the community. How many women need your services when they're in this kind of a situation? I mean, as I mentioned, I had a client only 18 months ago ask me, and I was unable to answer or help. I feel so badly about that because look, you could have helped her, or potentially helped her to sell her policy. It's kind of like having a pretty good car that runs, might not be new, but it still runs and it's worth something to somebody.
Right.
And if you don't know how to get in touch with that market, then you give it away to the junk pile, or allow the automobile companies to take it at nothing, um, no resale value. So how can people get in touch with you, Lisa?
So my phone number is 714 area code 349 7981. My
And we'll put
website,
that up on, we'll put that up below on
perfect.
our tag.
And my email, and don't laugh, is lrayberg at AOL.com. I've just had it forever. Or if you want the longer version, Lisa at RehburgLifeSettlements.com. But first initial, last name at AOL. And then the website is RehburgLifeSettlements.com. So
And
we're here to be of service nation. We do serve clients nationwide.
nationwide. And then finally, before I let you go, could you walk us through what could happen if somebody did call you? Could you just kind of walk us through how, let me just pretend that it's me. And
Mm-hmm.
I called you, Lisa, and I said, I have this term policy, and let's pretend that, there's a pretty nice size death benefit attached to it, and these payments are too much for me. How would you assure me that you could help me first, and could you give me the process that I could expect?
Absolutely. This is a 3 to 5 month process, start to finish. So it's like selling a house, very similar to selling a house. But the the conversation is just a real quick one because I'd like to know about your policy, right? Like you said, it's a term policy, it's ending in 3 months, or it's a universal life policy. So I would want to know, is your term policy still convertible? Do you have any cash in your universal life policy? Right, just basic information. And
Yeah,
then we would have a conversation as to what I think our opportunity is. Because remember, we don't know until we market it. Because I don't know what those premium projections are. I don't know what buyers are going to think your life expectancy is. But what I do know is, hey, this is a good opportunity. I think there's a good chance that we could get some money for you. Or B, this is probably not a good chance. If you're 45 years old and running marathons, there's obviously going to be no buyer for it,
mm,
unless there's some significant health issues. So I would ask about how's your health, what's your age, how's your health. All those things are important. And then sometimes it's, I think this is a borderline case, meaning that we may be able to get some money for you, or maybe not. And so that way the client can know, do they want to at least look at it or not. It starts with an application. So if the client says, you know what, yeah, let's market it because I don't need it, I'm going to walk away from it. So if you can get me anything, it's going to be a good thing.
okay.
It starts with application, really super easy. And then send the application back to me. There's no money up front. No one owes any money. We do our service free to find out how much a client can get. We then obtain medical records. That's the longest part of the process a lot of times,
Yeah.
and get premium projections from the insurance company, and then send it out to market. And we get offers or we don't. And so if we don't get offers, clients walk away. If we do get offers, clients are not obligated, right? Nope, Lisa, that's not enough money for me. And they walk away. So
Mm,
we are paid commissions, which are disclosed in sale contracts that clients physically have to sign.
mhm.
But we only get paid once a sale is complete and a client has money in their hands. So up
Wonderful.
until that point, it doesn't cost anybody anything to find out.
I see. So up to that point, you're gifting your services, which is to represent the client to your knowledge base of people out there who might be potential buyers, which I think is extraordinary. And what's interesting to me is that this exists at all. How many, final question, how many CPAs know about this? Let's say those of us who have investment capital, we talk to our CPAs, we talk to our investment advisors. As a former owner of an investment advisory firm for over 35 years, I've never heard of it. Of course, my time in that professional market was, from 1975 to say 2010. You said this started in 1980s, but I still have not heard of it. So it's not like I was not cognizant of insurance. It's a subspecialty that we had a license in, but this is just a specialty area. How many now do you think is a normal person when they talk to their CPA or investment advisor? Do they know about this?
They
No.
don't. They don't. And they either don't know about it at all, if they might have heard of it, maybe kind of, sort of, but most of them do not talk to their clients at all about,
Okay.
life settlements.
That's why I'm bringing something special to everybody
Yes.
now. I want everybody to know that this is like a diamond in the rough.
It's a thing.
So, Lisa, I mean, this is extraordinary. We have gone through this amazing financial change in our country where financial engineering has been extraordinary. People are coming up with new ideas on how to expand markets financially all over the world. I mean, case in point is the new bitcoins and this and that. That's all financially new, and to me, it's almost like the insurance industry has grown a new branch of expertise, and that's what we are talking about here today. And it's called it's called insurance settlements, which is really a special branch, a new growth area that you represent. And I'm so delighted to really introduce you to my people here. Well,
Like I said before, I'm so honored to be here to at least talk about this. Because as you mentioned, most people have no idea this is here. And I think I mentioned, but remember the 2.5 million seniors who lapse or surrender
yes.
last year, and that's every year. Last year, 3,218 sold their policies. That's it. Super big gap because they just don't know that we're here. So I'm grateful to you. I'm grateful to your audience for listening, and I just appreciate it.
And finally, this is not only for the listener's benefit in case you might have insurance policy, you may not. But what if you know somebody, or what if you have a parent who's in this position and they have a policy and they just don't know what to do with? This is important information, and you never know. The fact that you have this information now is power. I believe information is power, and you never know when you'll have an opportunity to utilize this power for your benefit or somebody else's benefit. So I really appreciate having Lisa on board. Is there anything else, Lisa, that you'd like to say at the end here?
I just, like I said, we work nationwide. It's a privilege to serve clients, and I am just grateful for the opportunity.
Well, I'm certainly grateful for you. Thank you so much for being of service to so many people who need this wonderful opportunity to gain more income from the assets that they already own, that where they might need that kind of secondary market. So thank you very much. Everybody, please reach out to Lisa Rehburg, and she's giving her the way that you can contact her. Please do so if you want more information. I know she'd be delighted to serve you. And so, with that, I want to thank you for being with us today, and join us next time for the next episode of Money Talks with Lynn Kitchen. Thank you so much.